All right, let's get right into it. The crypto market just got hit with a massive whiplash-inducing crash, and it has absolutely everyone on edge. You look at the charts, it's a sea of red, and the real question on every single person's mind is, what on earth happens next? And just to give you a sense of the scale here, we're not talking about a small dip. In an incredibly short amount of time, nearly $19 billion in value was just vaporized from the market. This was a genuine shockwave, and it's got fear levels cranked way up. And that really leads us to the fundamental question of the hour. Is this the first tremor before a much bigger, more painful correction? Or is this the final shakeout? You know, the last big chance to buy before the next major bull run takes off. Let's break down both sides of that argument. So first up, let's talk about the bear case. Let's look at all the reasons why this downturn could actually get a whole lot worse before it has any chance of getting better. See, this crash didn't happen in a vacuum. It was really sparked by some major geopolitical drama. The US announced these really aggressive tariffs and new export controls aimed at China, and that sent jitters through all the global markets, not just crypto. Whenever the world's two biggest economies start clashing, investors run for the hills. And all that fear creates what the pros call a risk-off environment. What does that mean? Well, in simple terms, it just means that big money doesn't want to gamble anymore. Investors start pulling their capital out of anything they see as speculative, and let's be honest, crypto is high on that list, and they park it in things that feel safer, like gold or the US dollar. That creates huge selling pressure. On top of all that global fear, there was another problem brewing inside the crypto market itself. A lot of traders were using leverage, basically borrowed money to juice their bets. But when the price suddenly dropped, all of those positions got automatically sold off to cover their debts. It's a domino effect, a cascade of forced settling that just hammered the price down way faster and harder than it would have otherwise. And that brings us to the charts right now. From a technical perspective, Bitcoin is sitting on a knife's edge. This price down, right around $110,000 to $112,000, is a massive support level. Think of it like a line in the sand that's held up the price before. If that floor breaks, well, the bears argue there's not much to stop a very fast drop toward that big psychological number of $100,000. But okay, that's the doom and gloom. That's only one side of the coin. Now let's flip it over and look at the bull case, because there are some really compelling signs that this could be a bottom, not a cliff edge. So, while a lot of smaller investors were understandably panicking, the big institutions were doing the exact opposite. Get this, in early October, a staggering $5.9 billion flowed into crypto ETFs around the world. That is not panic selling, my friends. That is strategic, big money buying from players who clearly see this dip as a major opportunity. This is what they call the smart money perspective. These guys often see these sharp drops as a fantastic entry point for the long term. At the same time, we're actually seeing some positive regulatory news, like the UK lifting its ban on retail crypto products. Plus, a brutal crash like this tends to flush out all the nervous, short-term traders, the weekends, and it leaves the assets with more committed, long-term holders. And this highlights a classic contrarian investment idea. The theory is that when fear and pessimism are at their absolute peak, when everyone is convinced it's all over, that is very often the point of maximum financial opportunity. Historically, this kind of extreme negativity can be a surprisingly strong signal that price bottom is close. Okay, so we have a really powerful bear case and a pretty compelling bull case. How does this whole thing resolve? Let's zoom right in on the immediate future and figure out the key signals you need to be watching over the next few days. Right now, the entire battle for the market's direction really comes down to these two crucial levels. You've got support, that's the floor we talked about, somewhere between 108 and 110K. That's the line the bulls absolutely have to defend. Then you've got resistance, the ceiling, up at 120K. That's the level the bulls need to smash through to prove they're back in control. What happens between these two zones is going to tell us everything. So here's how this could all play out in three possible scenarios. The bearish path. Another big global shock hits the news, we break that 110K support, and we start heading for 100K. The base case, the market just kind of chops around in this volatile range, digesting all the news. And the bullish path, we get some good news about the US and China, or that institutional buying keeps up, and we reclaim that 120K ceiling, signaling a real recovery. So, after laying out all that evidence, we come right back to the central conflict. Because right now, the market is literally being torn between two incredibly powerful and completely opposing stories. It's a true tug of war. On one side of the rope, you have the immense weight of geopolitical fear, all that forced selling from leveraged traders, and the very real risk of a technical breakdown. But on the other side, you have the quiet confidence of institutional money flowing in, that powerful contrarian signal from extreme fear, and the simple potential for a sharp bounce because things got so oversold. And that brings the final question right back to you. You've seen the arguments from both sides, the geopolitical terror versus the quiet confidence of smart money. So what's your call? Do you think this crash is the beginning of a much bigger correction? Or is this the last big dip before the next bull run really kicks into high gear? The next few days are going to be very, very interesting.